Okay, we're going to go ahead and get started here. Good morning. My name is Greg Brick. Uh, Along with me here, you can see Dan Von Lemden. We're both going to present today. We've got some exciting information to share with you. Before we get going, I always like to identify who we are, what we do, and how we do our work. Again, I'm the founder of Brick Retirement Group in Oviedo, Florida. We're a comprehensive financial planning firm. I'm a chartered financial consultant. We have been in the business of helping individuals and business plan their financial needs now for 25 years. So we're very proud of that. I think our claim to fame is we get to know our clients. We meet with our clients. With the advent of COVID-19, we're doing a lot via web conference, which has worked real well. So we help plan out every aspect of our clients' financial lives. So we take a lot of pride in what we do. We've got a wonderful staff at Brick Retirement Group. We've got Wendy Brick, my wife, Andy Hatton, Joe Shaw, Isaiah Reyes. We've got a wonderful staff here to serve you on a daily basis. So I'm real excited about our topic today. As you can see, it's on a given product. It's a financial vehicle that we at Brick Retirement use. And it's unique because all of our previous webinars have been focused on financial concepts, like how to get your lazy money working, how to prepare for where taxes could be in the future, timing and sequence of returns risk. We've touched on a lot of financial topics that impact every one of us. So today is very unique because we're not going to focus on a concept. We're going to focus on a powerful financial vehicle. And I've got no one better than Dan Von Lemden, who I'm going to bring up here in a moment. Dan and I have worked together for several years. He is very knowledgeable about the markets. He studies the market. I can tell you he was on Squawk Box early in the morning this morning. We did a little prep meeting for our web conference today. So he's very knowledgeable about the markets. He is an expert at IVA. What in the world is an IVA? I don't know what that sounds like, but it's an indexed variable annuity, an index variable annuity by a manufactured by one of the largest, most powerful insurers in the world, in Allianz. And that is the product, the financial vehicle that we're going to break down today. Dan is going to take the lead. I'm going to interject at different points. We got a great PowerPoint put together for you. And as always, we're going to open it up for questions at the end. Anything you want to know about our topic today, how to use the product, we'll be here live with you to walk you through it. Both Dan and I have a lot of experience with this given product together. So with that in mind, I am going to hand it over to my friend and associate, Dan Von Lemden. Dan, welcome.
Hey, thank you. Can you hear me?
Absolutely, loud and clear.
So we're not like most of those talking heads on the news networks. They have to hit mute. They have to turn their video back on. Let's hope we don't fall into any of those roadblocks. So thank you, Greg. Listen, Greg is one of our top advisors. He is actually a top advisor in the industry when it comes to money, financial planning, financial advice. So when we have an opportunity to partner with him on calls like this, we really want to first start off by just expressing the gratitude for including us. Thank you, Greg. And I'm going to jump into it. We're going to go through this really quick because I feel there might be some more value if there's some interaction. So as we go through this, write your questions down or start typing them in. Greg, I think there's a way to type in questions here. Is that correct?
Yeah, that is correct. Okay. So again, if you've got a pad of paper, a pen, as we go through the presentation, write down any questions that you have. And then at the end, I will give you a prompt to where you can actually raise your hand. If you click on your profile, you can raise your hand or you can message me directly with your questions. Thank you for that, Dan.
Great. All right. So let's open it up as to, why this solution, the timing for it is fitting. We have to, I guess, look at the options for our money. And I love lazy money, Greg. I understand there's trillions on the sidelines in cash, and there's lots of uncertainty, obviously, with COVID and everything going on. And, these markets don't seem to be reflecting it. The markets are going up, and the economy, who knows, right? Going in the opposite direction. It doesn't matter if you think it's going to be a V-shaped economy recovery, if it's going to be a U-shaped, or another term they use is the Nike swoosh, right? Which is just a slow recovery over multiple years. But everybody's looking for ways to deploy their money in the most productive way possible. So what are some of the options? Well, we can look to the banks. Obviously, lots of security, FDIC insurance up to 250 to 300. I think it's 250 still now. Again, it used to be 300. They kind of go back and forth on the coverage per bank. But what kind of return can we get? Probably 0.1, 0.2, 0.3% these days if you're lucky, and you probably have to go out 3 or 4 or 5 years to get 0.3. I'm not looking at CD rates these days. I know how bad they are. They're no better than money market rates. You might as well leave it in savings or checking. I don't think it's worth your time to tie it up for 1 to 3 years to get, basis points or a decimal point kind of interest rate. So if you don't do banks, what's another safe, secure option? Well, you can look at bonds. How safe might bonds be? Obviously, a better return than maybe the banks. You can look at government bonds. You can look at corporate bonds. And you might be able to get your returns up to 0.5 to 1% for government bonds, and maybe 2 to 4% for corporate bonds, municipal bonds, and the like. Of course, if you go into that corporate bond space, there's risk, and you want somebody like Greg involved in helping you identify the best bonds out there, because there's risks as well for defaults and so forth. And then interest rates are always risk. If rates go up, bonds prices go down. So you need to know what you're getting into there. The third area, equities, stocks, right? So obviously that puts a shiver down many people's spines when they hear that word stocks, the stock market. What we're going to talk about today is a way to get your feet into the stock market if you're not already, or keep you in the market if you are in the market, and have a company, the actually largest insurance company in the world, is going to take risk away for you. So you can have your cake and eat it too, as they sometimes say. So Allianz is going to say, we're going to give you the upside of the market, give you unlimited upside if the market's up, unlimited on the upside, but we'll take away 20% of the downside. So if the markets are down 20% or less, you can't lose money. So we're going to absorb risk with you. So now, before we move on any further there, lots of talk about the federal government. Why invest in the market? Is there a safety net? And we won't go too deep into this, but the federal government has been the hero for stock investors here the last several months, as they've been injecting cash and they've been buying bonds. And there's talk that they might actually buy stocks. They might start buying equities if they feel the economy and the markets need a bit of a backstop. It's controversial whether or not they should buy stocks, but the other thing is, will they buy individual stocks? Will they buy stock indexes like the S&P 500? But the point is, that's starting to be priced into the market, and that's why the markets are going up. Is, if the Fed's going to be there to back us up, it doesn't seem like there's a lot of risk. So people go into the markets in droves these days. Even the millennials with the various trading platforms are getting into the markets. So. But that doesn't take all the risk away. Markets are going to be up and down. Markets are volatile. So how do we take some of that risk away? So now we have a page in front of us, and I'm going to transition into kind of how this product works. What we're looking at here is 2 up arrows, 2 down arrows. Let's start on the upside, and let's look at that bottom one first. What this says is Allianz is going to let you, the contract holder, the account holder, invest in one of 5 different equity market indexes, and we'll just focus on the S&P 500 today. S&P 500 is the 500 largest companies in America. It's a basket of 500 stocks. and the largest stocks in America. It's the barometer that we use to monitor how the markets are doing. If you look at CNBC or the news at night, they generally tell you how the Dow is doing. That's 30 stocks, and how the S&P 500 is doing. That's 500 stocks. The S&P 500 is a proxy for the stock market, but that's the investment that you're starting with here. You're putting your money in a account that tracks how the S&P 500 is doing. So what this is showing us is over 3 years, what could happen. So the first thing that could happen is the market could be up a lot. Let's actually look at the top line. It could be up, let's say 80% over the next 3 years. Now, every month we change our rates or ceiling. We give you 100% over 3 years of whatever the index or the market does to a ceiling. And right here it says that ceiling is 70%. So if 3 years from now the S&P was up 80%, you would make 70%. They're off to the right. Greg's helping me identify that there for you. 70%. Now, what's unique is here in July, the pricing or the rate for the entire month of July, that ceiling has been taken away. So there's no cap. So we call it uncapped, no ceiling. So if the S&P was up 100% over 3 years, you'd get that 100%. If it was up 200%, you get 200%. There's no limit on the upside. So July is the highest we've ever seen these rates, and we don't need to get into the details of how we set rates. But the point is, it's an opportunistic time. If you're thinking about getting back into the market with some protection, this might be a good time for you to consider a product like ours. Below this, it says now the market was up only 40%. That's roughly, let's call it roughly 13% a year over 3 years. Well, since it didn't hit the ceiling, we got all of it. So you get 100% of what the S&P 500 performance is over those 3 years, and nothing's taken away from that. So in that case, you got 40%. That's your return. So 100,000 if I invested today, 3 years from now, if it was up 40%, it's worth 140,000. Now the two bottom lines that are downward trending are telling us or showing us what the results would be in a down market. Let's assume over 3 years the S&P is down 10%. Well, the S&P is down 10. I told you Allianz will protect 20% of the downside. So as long as the market is not down more than 20 over 3 years, you don't have a loss. So you can see there that your return is zero. So you didn't have to suffer the loss. Now, you didn't make anything, so you pretty much did what the banks would have done for you there, but you didn't lose anything because Allianz absorbs the first down 20. What if it was down more than 20? Well, in the next one, we see it's down 25% over 3 years. In that case, again, we would have absorbed 20% of that downside, so we would have had a 5% loss in that example. So now what we need to turn to is historically on the S&P 500 through good times and bad times, because we need to look at both, what historically might have been the experience over a 3-year period. And we did that, if we go down the next page on the slides, we did that going back to 1957.
Hey, Dan, may I take a quick time out?
Sure. Yes. Thank you.
Everybody in the room, I want you to hear this, from me. And I run into all different types of people from all walks of life. And just to share with you, we all work really hard, don't we? We all have ideas of retiring, and the markets are very daunting right now. They're scary, right? The COVID-19 came along and we had a big drop in the markets. For those of you that have 401ks, 403bs, thrift saving plans, if you're working in the government, and you saw this stark drop in your value. I commonly use this type of financial vehicle for those types of investors that are fearful of a drop in the market. I've got, clients that work in the federal government. They run to the G fund where they're not earning anything on their money, not even at a level of keeping up with the rate of inflation, right? This is a wonderful opportunity for you to say, look, I am going to give myself the opportunity to earn these great rates of return all the while minimizing my downside risk. And Dan is going to go back into a historical. We have to become educated on what has happened historically and what your risk is. But I want you to think about this. The largest insurer in the world comes in and says, you can see my cursor, we are going to absorb for you the first negative 20% drop. Anything -1 and beyond, we're going to insure for you. Okay? So I just wanted to reiterate the point and summarize. You've got unbelievable upside potential. It is now uncapped with this nice downside buffer that Dan explained. And we don't take lightly at Brick Retirement Group how important your money is to you. And the fact that as it relates to retirement funds, those are monies that you're going to need in the future to replace your working income. So I just wanted to share that insight with you there on how you can use this program. Dan, thanks for allowing me to interject. I'm going to go to the next slide. Is
Greg,
that okay?
stay on this slide for one more second, and I had one other point to that, which is a great thing to add, I think. There's two human psychological drives that we all have, every one of us have when it comes to our money. And it's probably 95 to 100% of what drives our decisions, what drives our experience. And if you're taking notes, it's simple, two acronyms for you. It's FOLO and FOMO. FOLO stands for fear of loss. And that points to the downward trending lines that Greg was pointing to, the -10, -25. So we fear losing our money. But it's also, loss, fear of loss, that's in all of us. We don't want to lose our hard-earned cash. So when we find things that can protect that downside, that loss potential, that's valuable. There's a real value in that. FOMO stands for fear of missing out. FOMO, fear of missing out. Those are the uplines. That's kind of the greed factor. You could say fear and greed. Fear is the down, greed is the up. But when we keep our money in the bank and we're earning 0.2 to 0.3%, we hear from a relative or neighbor that they're making 10 to 15% a year because they're investing the money in the market or whatever they're doing. It kind of gets us. It's there. It's that fear of I'm really missing out on some of this upside. And what we're doing with this solution we're about to go a little deeper into is we're trying to address both of those. We're trying to give you that upside to kind of give you the ability to have the pleasure or greed factor in play for your money, but also taking the fear factor of fear of loss off the table with that 20% downside protection. All right, let's go to the next page. So if we're going to be smart about this, let's look historically at what the markets have done. I might have you, there we go. Perfect, thank you, sir. All right, so let's just look at the blue bar. It says S&P 500, that's the index or the investment vehicle that's driving the return here. And let's go back to 1957 through January 1st of this year. And what we did on this is we said, let's look at every 3-year period. Every 3-year period, if I were to invest in the S&P, say 3 years ago, and I stopped 3 years later, which is today, what would that return have been? And then let's go back 3 years and 1 day ago and go back to yesterday. So let's look at every 3-year holding period from 1957 through January 1st of 2020. How often would I have had a positive return in holding the S&P 500 over 3 years? And you'll see in the green chart, you'll see 82.04% in the green pie chart, you would have had a positive return. And how often would I have had a loss where the S&P was down, the S&P 500, let's call it the stock market, was down over a 3-year period, but it was down 20% or less. And you'll see that sliver says loss within down 20, it would have been 10.45% of the time. So in that case, remember, we would have a zero return. We wouldn't have lost money because, again, Allianz would have taken that down 20 off the table. They would have taken it on the chin for that down 20. So how often then over 3-year holding periods would the loss have exceeded down 20? And we'll see that smaller sliver there. It happens 7.5% of the time from January 57 through 2020. So if we add up the positive returns and where we didn't have losses, we can see 92.49% of the time over these rolling 3-year periods, we would have had either a positive return or no loss. And it also then says, well, let's add up all the negatives and positives. What would our average return have been with every result averaged? And we would have had an average positive return of 26.8%. So 100,000 on average would be worth 126,000 at the end change at the end of 3 years. So then what the second pie chart there does is it says, well, let's go to 6 years. Let's say it's longer term money and we're doing 3 years. We either get a loss, absorb a loss, or have a positive return. We take that money and do another 3 years. So now we're looking at 2 back-to-back 3-year holding periods, which is technically 2 6-year return period that we're measuring. And it shows us 98.1% of the time we would have had a positive result, and we would have only had a loss, a very rare, less than 1% of the time, where it says negative return was 0.89. And the average now, since we're doing a total of 6 years, the average has more than doubled, and now our average return is 60% over that 6-year period. So 100,000 is worth 160,000 and change. So this is, I think sometimes you have to look back. It's obviously, as they say, past results are not indicative of future results, but sometimes history does repeat itself. So it's nice to have measuring periods and take a look at things from a perspective of what the results would have been when we lay over what this product can do, this solution can do for us. Now, Greg, did you have any other comments to add before we go to the last, well, actually the second to last slide before we have some Q&A opportunity?
Yes, as you're going through the actual numbers, the historical figures, Dan, I can't help thinking about lazy money and the impact of inflation on the purchasing power of your money. And we had used an example in multiple previous webinars where we isolated the current rates being earned in banks that you alluded to earlier at 0.1, 0.2, relative to an inflation rate of 3.5%. And I want everybody in the room to really think about lazy money as an example, or a poor performing part of your 401k, your thrift savings plan. Number one, as a baseline, all of us, need to maintain a rate of return at least level with the cost of living. Does that make sense to everyone? If the cost of living is going up at 3% a year right now and you're earning 1% on your money, you might feel good about the fact that you're holding on to your money, but you have to realize that you're losing purchasing power. Inflation eats away at the purchasing power of your money. And the examples that we've used in the past, I want everybody to think back 15 to 20 years ago and what it would cost to buy a brand new car then relative to buying a brand new car now. It's staggering. That's called inflation, right? The cost of living goes up. This is a neat way, removing a good amount of the risk. And when you're armed with the historical numbers and the chances of actually losing money, knowing that a company like Allianz, a large insurer, is going to absorb the first negative 20% of a loss. I think those are the golden nuggets in what you're sharing with us, Dan, right now, is that we can be in the markets. I love the analogy that you've used with me, Dan, that you've taught me. It's very much like driving down a mountain with guardrails. I think if we had a very skinny road that we were taking down a mountain, I think we all would love to know that we had guardrails to prevent going off the side of the mountain. And anytime I think about the IVA product, I think about investing money with guardrails around you. And we're going to get to a very important feature here in a moment. But anyway, I want you to think about those ideas.
Great. Thanks, Greg, for adding that. Let's go to the next page. Now, this part, Greg and I hesitated to share. It's a little bit of a deeper dive. Let's go actually one more. It's a little bit of a deeper dive, but this will tell you how Greg and I get involved in this and how we add our value as time goes on. Let's say we were to start an account today. Let's just use a number of 100,000 invested, and we decide on this 3-year kind of solution with uncapped upside of the S&P, 20% downside protection. Let's assume we're 11 months into the 3 years, so we're not even quite to the end of the year yet, and the market has had quite a rally. And let's assume it's up 30%. So our 100,000, if we were to look at a statement or online or call Allianz, it'd be 130,000 at that point. And we're thinking to ourselves, well, this has been great. You know, this market has done well, but I have another 2 years and a month to go until it gets locked in. Because what happens is at the end of 3 years, automatically, whatever your return is actually credited like an interest payment to your account that becomes your new account value. Every day in between the 3 years, we're telling you online or by calling us, or when you see a quarterly statement, we're telling you what the valuation as of that day is. So if the market's up, you're seeing your account's up. If the market's down, you're seeing that 20% protection there for you. But let's assume, again, in this example, 11 months into the year, into the first year, 100's worth 130,000. What will allow you to do, and Greg and I do this all the time, he has done this for many of his clients, is you can lock it in anytime you're happy with it. So let's say 100's worth 130. We have that lock symbol there. That becomes our new account value. You've just stepped up or created a high watermark for your account. And then at the end of that first year, it'll reinvest into a new 3-year term, but now it's 130,000, not 100,000. You've just created a value that you're going to redeploy at the end of that year to either one of the 1-year strategies or 3-year. We won't go into a lot of details on the options. That's where Greg and I come into play. We help you decide on how best to invest the money. But you have now basically redeployed 130 again into the S&P for a new 3 years, but with a new 20% protection under that 130,000. You've just established a higher value and now put a new 20% downside protection in place under that higher value. So a little deeper than we maybe want to go, Greg. I don't know if you want to add anything else to this. This is our part more, but anything else you want to share?
I do. And this is the part that I get most excited about. In front of me here, I've got my laptop, and Dan and his team at Allianz are really good at this. We work together to identify ideal times to lock in our clients' returns. I've got a report that came into me this morning. And I've got clients who have recently entered this very program that we're talking about today. And I'm looking at some returns that are, you know, and I've locked in some good returns even through COVID-19. So what I want you to take from this slide here is you could put money into this account today. And let's say in 2 weeks, there is a spike in the market for whatever reason. Great news on a vaccine for COVID-19. The markets spike, go up, and you're showing a positive return in your account that you're very happy with. I want you to envision that call coming in from me saying, hey, look, you put this money in 2 weeks ago. We're sitting on this rate of return. Do you want me to lock that in for you? And if we agree that that is the right thing for you, with a click of a button, I can secure the money you put into that account with that return on that given day. So I spend a good amount of my work week monitoring these programs with the help of Dan and Matt, the folks at Allianz that I work with, you know, to look for those opportune times where we can lock in your rate of return. And you know what? From that point onwards, your principal, the money you put in, plus what you earned is secured from any further downturn. So let's say 3 months later, there's bad news and the markets drop. Guess what? Every penny that you put into the account plus what we locked in is secured from that downturn. And at the end of your segment that we're showing you here, 1, 2, 3 years, we then re-enter the game and we do it all over again. So if you want to talk to me about how this lock-in capability works, just shoot out to me. Give me a call, shoot me an email, and we can get into some more detail. But Dan, I think and believe we did dig a little deeper here, but this is a valuable feature of the product that we're learning about today.
Great. Thanks, Greg. And we'll go to the last page. We'll close with this. This account that can be set up for you, you can set up multiple versions of this account. Go one more. There we go. We'll have more than just what we talked about to choose from. And Greg has used all of these strategies for different types of clients that have different kinds of risk profiles. Some people want to take as least risk as possible. And that's the bottom one. You see where it says, Greg is highlighting at the bottom right-hand corner, 100% protection. That means you can't lose money. The way that one works is it's a 1-year option. If it's based on the market, let's say the S&P 500, if the S&P 500 is down, you'll get a 0. If it's flat or up at all, you'll get 3%. So you're either getting 0 or 3. So let's say 8 out of 10 years, the S&P is flat or up, you're getting 3%, and 2 out of 10 years, the market's down, which is kind of historical averages, you're getting 0. That means you're averaging 2.4% on your money, which beats the banks by far. Or Greg sometimes will use a portion of the client's money, maybe 30% or 50% or whatever the case may be, to put into the no risk option, and he'll mix and match some of the risk on options with limited risk with the other portion of the money. So really what you have here is 22 different options that can be invested in. If you look at the top, you'll see 5 different colored index boxes. You have the S&P 500, Russell 2000, NASDAQ, emerging markets, and Europe. Those are your 5 different indexes you can allocate to within an account, and you can mix and match those any way you want. And then you decide, now on the 3-year, there's only the S&P and the Russell. I would prefer the S&P with uncapped. Now the Russell has an upside ceiling over 3 years of 60% for this month. I favor the S&P 500 for that reason, because there's no ceiling on the upside over 3 years. And then if we go down the next one, we'll see the S&P with an option of 20% over 1 year. Now that one only has a 10% downside protection all the way to the right. So if the market's down 10 or less over 1 year, you won't lose. If the market's down more than 10, you'll have a loss for anything beyond down 10, and your upside is capped at 20% for 1 year. I'm not going to go into all these because I think that's a conversation with Greg. He can go into that with you if you're wanting to learn more. I just want you to know that every year or every 3 years, you can change how this is invested in your account and decide to maybe go less risk or go more risk on. You can make changes. I call it risk on, risk off every year with Greg's involvement as well. There is a fee. This doesn't come for free, but as fees and expenses go, it's very low for this kind of product or solution, and it's all in. The cost is 1.25%. That's it. 1.25% is the all-in cost, which includes the money management, all the account fees. There is a $50 additional charge if the account is under $100,000. That's an account fee that's charged each year. But as expenses go, if you look at mutual funds and other things out there, you're not going to find something where you can have unlimited upside with some or maybe all, in some cases, the downside taken away. So just think of the value versus, say, a mutual fund or managed account or some other investment account you have with someone. It's hard to find something that takes downside away and gives you upside like this does at an all-in cost of 1.25%. So,
Dan, let me make a point on that, on the fee, okay? Anytime as consumers, we're all consumers, we buy varying goods, but when it comes to, financial product or any product for that matter, what you're paying for, there's got to be some value there, right? So I always say this, you know, many mutual funds are, depending on which funds, could be anywhere between 50 basis points up to 2 to 3%, with no ability to truly lock in your value and no real or any downside protection. So I always say, hey, what you're getting for that 1.25%, you're getting the ability to track these well-known, world-renowned indices that are diversified, anything from the United States, large companies, mid-size, technology, emerging markets, European. All right, so we've got a good offering here. You've got varying methods that you can use to, number one, protect your money, right? So you're getting an insurance. We insure our automobiles, our homes. But have you ever thought about insuring your retirement asset, your nest egg? So those are just a few of the value-driven items that you get for that fee. And when you say only 1.25, I think there's a lot of value that you're getting for that fee. So I think that's important to understand.
Right. And, you know, I don't know if, Greg, if there's any keyed in questions that might be out there. I really think we've covered most of what we need to cover on a call like this, probably deeper than we needed to, but maybe there's somebody that got some value from this. Is there any kind of question that anyone has? If so, Greg, I'll let you take it from there.
Yeah, Dan. Hey, Dan, thank you so much. So right now, and this is one of my favorite parts of doing a webinar, are questions that you have. Anonymous, you can shoot them out to me. For maybe for the good of the group, I'll read out the question, and you can do that by sending me a message. When you look at the participants, you can see there's 11 folks here today. You can shoot me a message with a question, and I've got a few popping in here. So the first one that I have is, just to clarify, can I lock in some of my money once a year? Dan?
Yeah, great. I'll just address it, Greg, unless you want to. You want me to address it?
Yes, please.
Yeah. Okay. Yeah, so let's assume we had an account where we used multiple of these indexes and multiple of these strategies. Let's actually use this, or very simple. Let's say we put 50% into the S&P with a 3-year term uncapped, and 20 the other 50% with 10% buffer for 1 year with the 20%. Each of those are able to be locked independent of the other. So if you have multiple options within an account, each one stands on its own. Each one can be locked when you're happy, and then you can let the others ride, or you might lock several, let the others ride, and then 3 months later, you're like, well, now it's time to lock this one. You can lock them independent of each other. I think that's answering the question, Greg, is it?
It is, and I'll just add to this, and I want I love the KISS principle. We love keeping things very simple here at Brick Retirement Group. This is an account where you take a sum of money and you place it in the Allianz IVA. Every year we can pick one or an array of these different indices with varying different strategies, and I will help you pick those. I know them inside and out. I'll help you create the portfolio that we're going to use. You can change it every year, one time per year on your contract anniversary. And what you can do from the date that you put your money into your account, you can lock in your value with a push of a button. It's as simple as that. Okay, so to answer your question directly, we said exactly that. And we're very forthright in how we break down our products. You put your money in and you can lock it in at any time. And so I think that's, yes, that's exactly what we said, and that's exactly how it works. I've got another question. Greg, can I use this money for my 401k asset? And I think that is a great question. I'm going to share with you, I use this product in multiple different situations. I did a case this week with an individual who hit age 59 and a half. When you hit 59 and a half, generally you have the ability of moving out the monies that you have in a 401k if you're in the private sector. If you're in the public sector, you might have a 403b or a 457 deferred comp. If you're with the federal government, you have a thrift savings plan. Any of those accounts, when you hit 59 and a half or older, or you leave your employer, you have the ability of rolling that money out without any tax liability. So I use this account frequently for someone that has accumulated a sum of money. They're looking at that money and they're saying, I am going to need that money in retirement to be able to walk away from work and truly retire. I want to grow it. I want to continue to grow it, but I want to know that I've got some ability to protect my downside, minimize my downside risk. And don't forget, we can lock in your rate of return. I've got clients that tell me, Greg, if I could earn 8% in this account, please lock me in. I have the ability of setting that parameter in your account, so when it hits that point, we can lock it in automatically. On that note, I want to tell you this, and I know I'm going off on a bit of a tangent, but I think it's important. If I were to ask you what the markets have averaged on an average annual return over the past 100 years, in your mind, what do you think that average might be? Okay. That answer, and you're going to get a few different answers depending on how the reporting organization, will calculate it, but anywhere between 6 to 8% is what the markets have done on an average annual return over an extended period of time. So I think it's very fair as a barometer. If you could earn, I think everybody in the room may agree that if you could earn anywhere between 7 to 9% on your money on an average annual return, I think you'd be very happy, right? And I'm not saying that's a guarantee of what we can do, but those are the benchmarks that I look for on a weekly basis in my clients' accounts. If I get into that range, those of you in the room that have this account know this, you're going to get a call from me giving you the opportunity to lock in. Okay, so that was a long-winded answer that yes, if you have a 401k from a former employer that's still sitting there, we can use this account for it. If you're a government employee, a state employee, or in the private sector and you're over the age of 59 and a half, guess what? You can roll that money out and benefit from the protections that we offer in this program with the ability to lock in a rate of return. So we use it in many different ways, but yes, we can use it for a 401k. I've got a question here from someone. We'll do a few more here. Good question. When can you unlock? When can you unlock? Dan, I think that's a great question, okay? You want to go ahead and take the lead on that?
Yep. So once you lock an option, it's only the year that you're in that matters. So technically, let's say 4 months into a year, we're real happy with where we are and we want to lock it. It'll sit in cash uninvested until the end of that year for the remaining 8 months and automatically reinvest back in the option you were in, or I should say the index or the type of strategy you were in at the end of that year. Or if you want to change it to any of the other strategies, you can do that at that time. It's real easy to change it. Or if you don't do anything, it's real easy to lock it. You just press a button or have us do it for you. By the way, I'd recommend you work with Greg so he can help you with the locks, but you could technically do it yourself. But once it's locked, it'll sit in cash for the remainder of that year. Even with the 3-year option, if I lock it in the first year, I don't have to let it sit in cash for 2 additional years. At the end of that segment year, in this example, we were at 11 months in, we locked it, it would sit in cash for a month. and reinvest at the end of that year to a new 3-year or any of the 1-year strategies. So you can change it or leave it, just reinvest where it was after you do a lock. Greg, did I answer it sufficiently?
You did. And I'm going to give you a little bit of a visual here on that point. Okay. So you can see year one, you put your money in, we're riding the markets. We get to the point here, let's call it the 8th month. I'll just call it the 8th month. We make a decision to lock in. Your principal that you started with what you earned at that point when we lock in, is removed from the markets, if you will. There's no further risk. There's no further upside potential. And you remain on that plateau. And then we start year number 2 at that level. And then we restart the game. Okay, so at any point that we pull out, to be clear, everything you put in plus what you earned up until that point is secured until the end of that year, like Dan had indicated. And again, if you're interested or you want to find out more, obviously there's no obligation. Give me a call. We can go through this in greater detail and see if it applies. I'm going to make one more point here for everyone in the room. It is so important to understand, being a chartered financial consultant, looking at everybody's situation is different. This may not work for you. And if it doesn't, we'll let you know. Okay. So I don't want you to misinterpret that this is the end all. It is a wonderful program, but it's not for everyone. And that's what we need to determine. We use it in a lot of different situations, but again, I don't want you to take the information I'm telling you today saying, this is where I need to be, because I know there's folks in the room where this may not be the right thing, right type of account. Their needs may be very different. It may be income oriented. We need guaranteed income or whatever the case may be. And that's what we do here at Brick Retirement Group. We get to know you. We put a plan together. We understand what your goals and your objectives are. And then what I do is I go out in the open marketplace and I identify viable products with large companies that have a strong reputation to accomplish those goals and objectives. And I always say this, IVA is a tool. And it's a tool that you're going to use in certain situations. And I use the analogy, you go into your toolbox, you got a hammer and you have an axe. If the job to be done is getting a nail into the wall because you're going to hang a picture on the wall, you are not going to use the axe to hammer in that nail, right? So the point there is, the key in my line of work is identifying goals and objectives and then applying correct financial principles and in turn the right financial products. This is an ideal account for someone that wants to get return but doesn't want to take the downside risk, and they want to have a degree of control in when they lock in that gain. Okay, so just keep that in mind. I want to make sure you understand that. We are at 50 minutes into the webinar, and I'm really happy to see that, we only had one drop off, which is fine. We went a little overtime, a little OT, but we're going to go ahead and close it out. As we do in every webinar, wonderful Joe Shaw, my son-in-law Isaiah are going to follow up with everyone just to say, hey, look, if you want to find out more, we're here. I'll coordinate a phone call with you. If you want to come in and meet with me, we can do that as well and answer any questions that we can for you. Okay, so with that in mind, Dan Von Lemden, I want to thank you for taking the time with me, my wonderful friends and clients, and those that are looking at Brick Retirement Group as a potential financial planning firm for them. taking the time with all of us to educate us on this account that you're around on a daily basis. So thank you, Dan. And everyone that's taken the time today, an hour out of their important days to take time to learn more about financial options. So thank you, everyone. Love you as always. Thank you for taking the time. Let me know if I can help in any way. Have a great day. If you're around here, it looks like a rainy day right now in Oviedo, but take care, be safe. I wish everyone the best, and we'll talk to you soon. Thank you.